everyone, welcome to our PIN 957 group presentation. We will cover our work on the algo to market making strategy, option strategy, and hedging with option. This was the collaborative effort by our team, Kritika, myself, and then Kirupa, Sachin, Mandira, and Rejna. Here's what we will go through today in this presentation. First, the algo trading, both overview and logic, and then option strategy, setups and diagrams, and then lastly hedging strategies and results. And you can see here in the structure part, and then after there that is algo overview, and then in algo overview, algo focused on creating a market making algorithm that submits bid and ask queries around the current market price and manages risks through inventory control. Our algorithm uses VBA in Excel to interact with the RIT platform. The logic involves submitting one bid at last minus spread and one ask at last plus spread, cancelling orders if only one slide is active or a trade is partially filled, dynamically adjusting order volumes based on inventory to keep the position close to zero. And from the next slides, Kirupa will take over. Thank you.
Hello, my name is Kriparanjani Venkatesh and I'm going to be explaining the logic used here behind the algorithmic case. The bid price is coded as last minus spread while the ask price is coded as last plus spread, and a static spread of 0.02 is used throughout the case. The reason why we've used a static spread here is at the time of trading there were only 3 traders present at the market, which did not seem very volatile, so at that time it seemed like a good decision to make. And while the spread has been static, the order size has been maintained dynamic based on the inventory. That is, if the position was a positive number, a sell volume of 3000 was used and the buy volume of 1000, and if the position was negative, a buy volume of 3000 and a sell volume of 1000 was used, and it was coded in the Excel with if function to maintain the position for our benefit. And if the order was partially filled, it gets cancelled and resetted on its own, and the inventory threshold is maintained at a plus or minus 20,000, and the continuous coding is maintained, and the position is closed at 0 by the end of the simulation. Now let's look at a quick performance summary of the algo case. The final P&L shows a profit of $700. Now repeating the code for a couple of trading windows proved us something, that while the coding is risk defensive, it is not very aggressive at the same time, which is why the profit seems low, but it has also been observed to be stable. And the number of orders were 88 and the final position maintained was 0, and the trades were 51 and the trade volume was 98,000, and a rebate of $1,290 and a commission of $960 was paid. And the performance reflects high fill efficiency, strong risk control, and effective inventory neutral coding.
So next we have the option strategy case where we tested 4 different strategies in a simulation and recorded their performance. So the first one is short straddle. In this we sell a call and a put at the same strike price, which is $49, using 30 contracts each. And as you can see, the payoff graphs looks like inverted V. And in this, the highest profit is when the stock price stays around the $49. And we incur the losses if the price moves above and below the $49. But in our case, the price stayed between $47 and $50, which is break even for us, and we recorded the profit of $5,490. Next, we have long butterfly. In this strategy, we buy a call at $47, sell 2 calls at $50, and buy another call at $53. So the payoff graph looks like a sharp tent, and we achieve highest profit when the stock price ends close to the middle strike, which is $50. Because the losses, and we incur losses if the price moves too far away, either below $47 or above $52. Because we bought option at these outer strike, the losses can't get any bigger beyond these points. In our case, the price stayed near $50, so we landed in a profitable zone and made a profit of 13,200. Now I'll hand it over to the Mandira, and she will take you through the next two strategies.
Thanks, Sachin. Hi, this is Mandira. Now I'm going to explain the rest of the strategies. Short strangle. N- let's look at the short strangle, which is generally considered a more conservative strategy compared to straddle. In this case, we sold a put option as $47 and a call option at $51 with 60 contracts each. This approach works best when the underlying stock remains within the strike prices between $47 and $51. It offers a wide range of profitability than the straddle, but the cost of receiving a lower premium. In our scenario, the stock prices stays well within this range, allowing us to earn a net profit of $3,960. However, it is important to note that while the range is wider, the risk is still unlimited beyond the strike prices. If the price had moved significantly beyond 47 or 51, losses could have escalated rapidly. The payoff diagram shows a flat zone between the two strike prices, but if the price moves beyond either strike, the losses grow sharply on both sides, no built-in protections. Short iron condor. Lastly, we have a short iron condor which involves a total 4 legs. We sell put at $48, buy put at 50, sell call at 51 and buy a call at 52 with 50 contracts each. This strategy is designed to profit when the stock prices stays between two short strikes, in this case 41 and $51. It is a popular choice due to define the risk reward structures. Unfortunately, in our case, the stock price moved outside the 48 and 51 range, which triggered a loss of $4,200. While we incurred a loss, the maximum possible loss was capped, thanks to the long call and the put option that provide protections. The payoff diagram features a flat plateau between $48 and $51, representing the profit zone. But unlike the short strangle, the losses are limited beyond the range due to the protective long options, creating a safer risk profit overall. Thank you.
I'm Rizwanul Alam. Now I'm explaining the hedging strategies. On this slide, we outline the hedging strategies implemented during the simulation. So we started with an asset of 100K power shares, which we aim to protect against the downside risk. So to do this, we constantly bought the 1,000 at the money put option at the strike price of 19 in January, February, and March. The objective was to protect against price declines while limiting the cost of hedge and preventing the upside potential of the stock. The next slide is the H2 payoff diagrams. Here you can see the payoff diagrams and the results from the RIT performance report. The protective puts triggered payouts whenever the stock price of Pogo fell below 19. In January, the stock at 1750 and we gained 120K. In February, the stock rise to 1890 and the put expired, the resulting in the net loss of 14,000, with just the cost of the premium. So in March, the stock dropped again to 1690 and the puts paid out, giving us the gain of 135K. So overall, the strategy effectively cushioned loss, the downturns, and prevent the upside in rising markets. So finally, the rationale behind this approach, we maintained a consistent put buying over the 3 months, which ensured protection throughout the simulation period. The fixed strike price at 19 was effective during the period of decline. Throughout, it became less effective when the stock price fell down. So, nevertheless, the strategy successfully prevent the capital despite the premium cost. So, one recommendation for improvement would be considered adjusting the strike price each month to stay closer to at the money for more efficient hedging. This concludes my presentation on hedging strategies. So thank you for watching and reviewing our work. So if you have any question or feedback, please feel free to contact us and we will be happy to discuss them. Thank you so much.